One.
Welcome, everyone, to today's webinar called Asset Protection Planning for Business Owners and Professionals. So today is August 7th, 2024. We welcome everyone who's attending live, as well as those of you who will be listening to this after the fact, after it's recorded and distributed. But either way, we hope you get a lot out of today's webinar. We have some really good information and some really good speakers to discuss asset protection planning, and then how all of us can benefit from it in our businesses and our daily lives. So just real quickly, I'd like to make some introductions. Those of you who have attended our past couple of webinars have already met Todd Hudgens. Todd is a CPA, also an estate planning attorney, asset protection planning specialist, has a graduate tax law degree from New York University. You may or may not have met me before, but we have a firm by the name of Providence CPAs. For those of you who are not yet clients, and we have a focus on with our clients of focusing very heavily on tax and estate and asset protection planning for our clients. And then most of you have probably seen or heard or met Angie O'Day. She's our client success manager, so she's on the call today as well. And then for the first time, we have a very well-known comedian, musician, extraordinaire in the area of private insurance, Craig Clemens. So Craig, welcome to the team. And if you'd like, just to briefly just tell us a little bit about yourself and your background, and how you, and maybe how you know Garth Brooks.
David, thank you. Good afternoon, everyone across the country. Craig Clemens here. So my 30-second bio is right out of college. David mentioned I play guitar at a little honky-tonk called Eskimo Joe's. That lent to a career with 11 years Anheuser-Busch, and then I transferred to PepsiCo and Frito-Lay. So my early careers was Fortune 500. And then I was gobbled up after my NCAA stint at my alma mater by a gentleman in Oklahoma City doing $3.5 billion in staffing. So he's the largest and most successful franchised staffing company in the world with 600,000 employees, believe it or not, $3.5 billion, wearing the hat of business development and public relations. I did some real estate, but really I caught hold of private insurance back in 2019. But really what we represent is a company that goes back 30 years. So what we do, and we'll share this with you, is we stand up private insurance companies and we domicile them here in Oklahoma with a Native American tribe instead of going offshore. So we have just a beautiful model and really helping business leaders coast to coast. So David, thanks for the opportunity for me to be here.
Yep, thank you. And we're going to have a little bit more to talk about on private insurance later in this webinar. And then just an advance notice, we have a completely dedicated separate webinar where we're going to do a deeper dive into private insurance and all the many benefits and ways you can use it, especially in helping you build a tax-free retirement income, which I think is on everybody's mind now, especially with the elections coming up and not knowing what our future tax situation is going to be. But we'll have that webinar coming up. Everyone will get an invitation to it. Hope you can join that. It'll be on August the 21st. Right now, it's going to be live at 4:00 p.m. Central Time. So anyway, just real quick, just top of the list, disclaimer, everything we're going to talk about today is within the four corners of the tax law and in any other applicable state or federal law relating to asset protection planning or private insurance. So nothing we're going to promote or say is intended to result in anyone getting in trouble with the IRS, assuming you follow the rules and you don't abuse any of the laws that we do have. And just from a standpoint of what we plan to cover today, the first part, we'll do a little bit of an introduction to asset protection planning, talk about what that means, why it's important to you. Todd will lead that discussion, and then also talk about asset protection or planning strategies, a little bit more of a practical side of what type of entities and work in what situations. And then we'll transition over to Craig, who will talk a little bit about the background and the history of private insurance and how you might be able to utilize it. Again, this will not be a deep dive into private insurance, but it really deserves its own separate webinar to go into a little bit more details. We'll move into next steps and open it up for questions and answers. So if you have any questions in the meantime, just go ahead and put them in the Q&A box, and we can be reading those so we can get ready to go over them at the end of in the webinar today. So with that said, I'll turn it over to Todd to talk about asset protection planning.
Well, thanks, David. I appreciate it. And everyone, thanks for joining us today. We look forward to hopefully sharing some good information with you all that you can put into practice and that will be beneficial to you in helping you protect your assets. So we first of all, we kind of want to define what asset protection planning is and what asset protection planning is not. And so really, when we think about asset protection planning, we want to look at our assets and basically protect those assets before we have a problem, right? And so often when I meet with a client and we start talking about asset protection, we look at what assets might already be protected. And the law does give you some protection over some assets without you really having to take a lot of action. Some of those assets that are already protected are your homestead. And so you guys might be familiar with that, but your home is protected under usually state law. And then also many types of retirement plans are protected. So when you think about things that you can just do on your own, you can pay off your house. That's a protected asset. You can contribute money to certain types of retirement plans, and those don't require any type of complicated asset protection plan. But when we think about assets that might be subject to a creditor, there's plenty of those out there as well. So you think about your business interest, you think about your bank accounts, you think about your brokerage accounts, your CDs, all these assets that you've worked really hard to accumulate and that would be subject to a judgment creditor if you got in a lawsuit and that creditor didn't settle for maybe what you had on your limits on your liability insurance. So that's why it's extremely important for us to look at asset protection planning, and we have to put an asset protection plan in place before we have a problem.
And Todd, Todd, real quickly, one of the assets that we most of our clients have, that's usually one of their biggest assets, is their business as well. And so if their business isn't set up properly, it could also be subject to those creditors as well.
That's a good point. And so it's lots of times people don't even own their business in the entity too, right, David? We have lots of clients that just own their business and they operate it as a sole proprietorship and everything's in their own individual name. You might have a DBA, doing business as, but you don't have any kind of entity protection. And so that's a good point that David brings up, is that it's really beneficial to look at how you're operating your business and make sure that you're operating that business using the proper type of entity. David, do you even see some business owners that split their business out into multiple entities?
Especially when they have different investments or assets in their business that have their own individual risk. So dividing that risk. So I use the metaphor. It's kind of like putting all your apples in one barrel. If one of those apples goes bad, it can poison the other apples. Versus putting each of those assets that have risk into their own separate barrel, and therefore isolating what that risk could be.
Yeah, and so some of those assets might be, if you have a lot of equipment, perhaps that would be in a separate entity. Perhaps if you own your building, that might be in a separate entity. Any other things, David, that you see split out oftentimes?
Well, I think recently there's been a lot of interest in clients investing in rental properties or investment real estate. When prices looked like they were going up, everybody kind of wanted to jump on the real estate train And the good news is, we now have a number of states that have passed laws to simplify, that you don't have to have a separate LLC for each one. They've come up with, legislation to allow people to set up one LLC and have it be what's called a series LLC, where you can have basically subsidiaries that own each of the individual assets. So I've seen a lot of interest in that.
And then that's a great point, right? Because it used to be very cumbersome. If you had 20 rental properties, you had 20 different LLCs. And so we've seen that with a lot of our clients that have multiple rental properties, and they've been using this series LLC statute to basically protect each property from any liability that might occur on one of the other properties. And it also gives the client the protection that that creditor can't come through and get your personal assets as well. So yeah, that's great. Dave,
Yeah.
are you anything else before we go to the next slide?
Well, I like your definition here. That's kind of more of a
Good.
holistic across everything that, deals with estate planning, but it also incorporates the asset protection planning, especially in, making sure that, none of your property goes to somebody you don't want it to. But do you want to kind of go through these components of what an overall, estate and asset protection plan should look like?
You bet. Yeah, and I think this is a good definition, but basically, just asset protection planning defined is you want to control your property while you're alive, and you want to take care of your loved ones and yourself if you become disabled. You want to make sure you have enough assets in the event of a disability, and you basically want to give what you have to who you want, when you want, in the way you want, and you want to do all of that while you minimize your cost, and whether those be court costs or taxes or professional fees, or you definitely don't want to give it to a creditor. So yeah, very good definition just overall of asset protection planning. And like David mentioned, it really includes estate planning as well.
Yeah, and I also always like to use the word or the description in addition to creditors, predators and what sometimes in-laws become outlaws.
Yeah, that's good.
So you want to make sure you're protecting against all of those things.
Yeah.
So let's talk about why asset protection planning is important.
You bet. So, I mean, I think it's important because, lots of our clients, you work your whole life to accumulate these assets, right? You work your whole life planning for this retirement. And if something goes wrong and you don't have an asset protection plan, you may or may not have time, to rebuild those assets. So if you can't rebuild the assets because you're, and oftentimes maybe you only have one shot, right? Maybe you spent your whole life building this business, and you sell it, and if you got it all taken away from you, you might not be able to recover at that point. So I think asset protection planning is hugely important to make sure you have a plan in place. And you have to put this plan in place too, David, right before you need it. So you can't go run out and put an asset protection plan in place after you have a lawsuit that's been filed against you, can you?
Not that I'm aware of, or at least it puts the ball in the creditor's court that they can unwind whatever you tried to do. And matter of fact, it may even be before the lawsuit's filed. Maybe it's when you get put on notice that there could be a claim. That usually there could be a line in the sand that anything you do after that point, is too late.
Right. And I think that in the word for that, they call that a fraudulent conveyance. So,
Yes.
we can't engage in any kind of transactions that would result in a fraudulent conveyance. If you do something like that, the courts would probably just unwind it, and that it wouldn't work anyway. So that's why we encourage clients to do this before you need it, right? Do it before you even have a problem. Hopefully you don't have any problems, and hopefully you never need this asset protection plan. But I think it's hugely important that you put this plan in place before you need it. As we know, there's way too many lawyers in the United States, and you don't even have to have money to finance the lawsuit. So most of these lawyers would take these type of cases on a contingency fee basis. And So and many times, I know a lot of clients think, well, I have insurance, right? I mean, I carry, auto insurance, I've got malpractice insurance, I've got an umbrella policy, and those things are all good. So I don't think we're talking about that anyone should cancel any of those types of coverages that you have. We're just talking about additional ways that you can protect your assets. Um, David,
Kind of like
what's
just
anything?
filling in the gaps. Well, and then, I don't know how many people have ever done this, but I would say most people would not do this. And that is focus on the list of exclusions and exemptions that are described in the insurance policy that happens to be the lowest bid, that you're looking at, because you think, well, they all must be and act the same and insure the same types of risk. Well, that's not always the case. Typically, the less expensive policies exclude and exempt more potential risks from it, because they aren't willing to underwrite that risk for whatever reason, but they also are hoping that you will take their lower price. But you basically in that situation get what you pay for. I also like to use explain asset protection planning as far as having it put in place a lot like when you need insurance. I mean, you don't wait until your house has been destroyed by a hurricane and then you go buy hurricane insurance thinking you now can have the insurance policy help you rebuild your house. Same way with car insurance. You can't buy car insurance after the fact. And knock on wood, if somebody was able to, you wouldn't buy life insurance after you died. You couldn't actually, but there's no such thing. So asset protection, as far as timing, needs to be put in place before that risk happens. So if you wait too late, it's too late to get it. Generally will and can and will be unwound if the creditor understands that you tried to hide the assets after the claim was known.
Right. Well, and David too, let's talk a little bit about where do you see, or who do you see as being in most need of an asset protection plan? Are there certain professions, or are there certain people that you think really should focus on putting an asset protection plan in place?
Well, I think it's a personal question based on somebody's risk tolerance. If they tend to be more risk averse, if they tend to be less trusting of insurance companies, or our judicial system, which if you think any successful business owner or successful professional will have a chance of having a jury of their colleagues and peers and friends on the jury. They may not know much about how jury pools are decided, but for the most part, the people that are going to make up a jury are going to be people that look more and act more like the plaintiff that's filing the lawsuit. So if you want to trust our judicial system, you can up to a point, but it wouldn't probably include having a jury or a group of people that are going to decide your fate. So then you fall back in that situation on insurance companies. Insurance companies aren't in it as a nonprofit. They're in it to make money. So they very much need to control the risks that they insure, which means that it's not a blank check. So you need to be very careful, not only with what a particular policy is designed to cover, but also know what the limits of that coverage is, because in today's litigious society, again, relying on a jury, $500,000 doesn't go very far anymore, nor does $1 million when there's a loss of life or a loss of income or a loss of a business opportunity. So you have to really sit down almost with more of a pessimistic view and say, okay, what do I have to lose, and what are all the reasonable steps that I can take to protect it? And you go through and actually read your insurance policies to identify what they cover. To the extent that you can protect yourself through legal structures, that helps, but nothing's 100%. And then to the extent that you can, just make sure that you don't have to set anything up after the risk happens, because then it's just too late.
Right, right. Well, that's a good point. I mean, and I liked your point about the fact that really understanding these insurance policies. I think, at least I find in my practice, that most clients have never even read them. We had a client that actually had what was referred to as a wasting policy. You guys might be familiar with that, but a wasting policy basically, as you're paying money, your insurance company is paying money to your lawyers who are defending the lawsuit against you. The amount that your insurance company is actually going to pay is continuing to go down. So if you go through this 2-year lawsuit and the client gets the creditor gets $1 million judgment against you, you had $1 million limits on your policy. If they spent 500,000 on the lawyer fees defending you, then you'd be out of pocket the other 500,000 to satisfy the judgment. So just understanding your policies is extremely important. I think another thing that's important is just really, like David said, I mean, who needs an asset protection plan? That's kind of personal to each and every person. But I would say that there's a lot of professions that are more subject to litigation. I mean, obviously doctors, right? I think doctors are more subject to litigation. Maybe lawyers and perhaps other professionals. But even as a business owner, I think lots of times you run around with a bullseye on your chest. And the more assets you have, the more you have to lose. And so we often too like to look at our clients' assets and kind of just figure out what are the assets that we really need to kind of put a hedge around and make sure that they are protected in the event of a lawsuit. So yeah, Dave, I think that's a good point. Anything else you want to add there on why asset protection planning is important?
Well, I just suspect that the term wasting insurance was what the reaction was of the insured when they figured out that their policy wasn't going to pay as much. The probably reaction was, well, that was a waste.
Yeah,
So
yeah, that's right.
no
That's
pun
right.
intended.
Yeah, exactly. Well, let's kind of, oh, go ahead, Dave.
I was just going to say, let's move into some specific or practical strategies that we might be able to tell our participants about.
Okay, sounds good. Well, let's talk a little bit about the trifecta. I know that you like to talk about the trifecta too. So, but really, it's kind of an interesting model that David and I use a lot in our practices, and just kind of explaining how we like to segregate assets and protect them as opposed to your ordinary income that's coming in kind of on a regular basis. And so obviously, if your ordinary income that's coming in on the left, and we have your other assets on the right, and then this whole thing is controlled by a revocable living trust, ideally, as you can see at the very bottom of the slide. And then we put this red line, right down the middle, right? So we're trying to separate your ordinary income from your other assets, which are going to be your investments and some of the other things that we're getting ready to show you on the slide.
And so I think the diagram is a simple way to planning all kinds of correspond or relate to each other. When you have an operating business, for the most part, that has the bullseye on its chest, you don't want to have that business or that asset necessarily accumulate a lot of wealth or assets. You instead want to move those assets over time, either tax efficiently or outside of that business, over to the right, where you can then protect them. So again, this is a simple little diagram that we use to explain the importance of all three of these components being part of our clients' planning. So most of the time, it starts with a business on the left that can be an S corporation. In most of our clients' cases, we may have another business where we push income over for employee benefits or other reasons. We may put a label of an administrative service company for that, and then as the clients accumulate in investments, they slowly start building wealth through various types of investments, whether it's cash or public investments or private equity or real estate. But all of those assets need to be put in the right type of wrapper, either in a series LLC if you've got multiple assets or individual ones. But then at the end of the day, all of the ownership chain, flows down ultimately to that revocable trust, to the extent that it, doesn't have a beneficiary designation such as a retirement plan.
Yeah.
So anyway.
Oh, go ahead, Dave. Well, I was just
go ahead
and talk a little bit about your stoplight.
Well, I use the stoplight just because not all retirement plans are created equal. So you have some that are, that ideally in an ideal world, you have, retirement plans or tax efficient savings vehicles that are allow you to have a tax deduction, either in part or all on the front end. The money, your investments grow tax deferred, and then your access to that money at the end of the day is tax free. So there's a couple of those that are, what I put in the green category. You have others where I would put in the yellow category, where you may not be able to deduct the contribution that you put in, but assuming that you put in something that's going to grow, well, and not trusting what tax rates are going to be in the future, you at least don't have to worry about that if you don't have to pay income tax on the back end. So those are increasingly more popular nowadays, just because of more and more doubt about tax rates going lower versus more practical, reasonable chance that they'll go up. So you don't want to put something away in a tax deferred account at a today's tax rates. If the tax rates double when you take it out, that wouldn't have made sense to do that. And then you have the one that I put here that's really just kicking the can down the road. So it's it's an example of a retirement plan where you're putting money in tax deductible, but it's going to be fully taxable when it comes out. So it sounds attractive today when you're saving taxes, and everyone doesn't want to pay any more tax than they have to. So it's really tempting to put as much as you can in a tax deferred retirement account, but all you're really doing is pushing the problem down in the future, and none of us really know what that future is going to look like. So those are the ones that you, as a last resort, you may want to consider, but you definitely want to maximize everything else that you can, where you can put a tax deductible a contribution in, and then have it grow and come out to you tax free. So I use that stoplight approach just to explain the difference between the tax aspects that retirement plans have.
Gotcha. Well, and I like this slide too, David, because just like you mentioned, it's nice to have a wrapper around a lot of these assets. So a lot of these assets, you're showing a good illustration of how you can a person can protect them. So I think it's a neat way. Not that everyone's going to have every one of these pieces. So certain clients might have certain pieces, and maybe they don't have other parts of this slide, but it is a neat slide to look at.
Right. Yeah, and I borrowed a picture of Craig's house here to put here on the as an example of the personal residence. But we have all of your assets that you have title to ultimately need to be held either in an LLC or an asset protection trust or the revocable living trust. They all they all intersect, and they're related to each other. For those who are interested in more information on offshore asset protection, there's a really good website, assetprotectiontraining.com, that I'd recommend that you look at. There's several videos as well as a lot of articles on that. It's created by a tax attorney who's one of Todd's and my colleagues from NYU, that he specializes in asset protection planning, but his name is Rob Lambert. He's a big fan of having an offshore LLC and offshore trust domiciled in Belize. So there's a couple of specific reasons why he recommends that country over others. But at the end of the day, and then especially coming up to the sunset of our current Jobs and Tax Act of 2017, where the estate tax exemption is going to expire and go back to the pre-2018 amounts, adjusted for inflation. So as of right now, the law says that the estate tax exemption will go back to $5 million adjusted for inflation since 2017. So that'll put it probably in the mid 6 to 7 million range. But more importantly, it's going to put a lot of people who are under the radar of the current exemption, which is over $12 million or 25 million for a married couple. Now it puts them right there in, in the crosshairs of potentially having to pay that 40% estate tax. So one of the things that, probably one of the first things you want to do is to the extent that you have life insurance that you acquired that's still in your name, you may want to do the simple thing of creating a separate trust, an irrevocable trust to transfer that policy into. It requires a 3-year waiting period, but at least it's something you can do to get part of what would otherwise be included in your taxable estate out of your estate.
Yeah, David, that's a good point, and that's a pretty simple strategy too, right? Just to use an irrevocable life insurance trust and pull that death benefit and the policy out of your taxable estate.
Yeah, and they have kind of gone out of fashion for a while because the estate tax exemption's been so high for several years. But back when Todd and I first started, our professions, the estate tax exemption was a meager $675,000. So you can imagine, and of course that was several years ago. But so a lot's happened to wealth in the meantime. But the point being is that there were a lot more people, successful people, that were subject to that 40% estate tax several decades ago. So strategies like a life insurance trust and other wealth transfer strategies were very common back then. And I believe those things will come back into popularity, especially if that estate tax exemption goes back down.
Yeah, and David, one other thing, just on the life insurance trust, I think, it's pretty widely known that the, life insurance is the money inside of a life insurance policy is creditor protected, but you're kind of just giving another wrapper, aren't you? If you put your life insurance policy in an irrevocable life insurance trust, another hurdle for maybe a creditor to try to jump over.
Absolutely.
Yeah.
Yeah, and really the cash value is protected until you need to take it out, and then right. It's potentially subject to because your creditor steps in your shoes, and if you take money out of something like that, they might step into your shoes and get the money first. So you just have to be careful when you already have a claim against you, and whether or not you can actually access some of those assets that would otherwise be protected.
Right.
So let's shift a little bit to talk about more specifically maybe a couple of uses of limited liability companies, and then a little bit of an overview on asset protection trusts. So I guess the first topic here is, Todd, tell us a little bit about what is described here as a charging order protection entity.
Okay, so the charging order protection entity is a super neat entity that is available in 13 jurisdictions, and it's really basically a limited liability company, and the specific state laws provide that protection. And basically what it says that if a creditor gets a judgment against you and or against your limited liability company, that they cannot force your assets out of that limited liability company. If you have charging order protection, this creditor cannot force you to liquidate those assets. And so I think it is important that if you're going to set up an LLC, you want to set it up in a jurisdiction that has charging order protection. There's 13 jurisdictions that have charging order protection, and the ones that we use mostly are Wyoming and Nevada, and then we use Oklahoma a lot because I'm actually based in Oklahoma. But that's a pretty neat thing, and you want to make sure that is incorporated if you're going to use limited liability companies. David, anything to add there?
Well, I think of particular concern for those out there who have LLCs, and if they're single member LLCs, those are the LLCs that in these states other than these 13 jurisdictions have case law increasingly. So it's an ongoing trend increasingly that allow a plaintiff to pierce the veil of that LLC to get to the assets more than not in a situation where it's a single member LLC. So it's all the more important that if you are the only member of an LLC, that you seriously consider, setting up that LLC or moving it to one of those 13 jurisdictions.
Right. Well, that's a good point. And I think too, we maybe should just mention a little bit, if you're going to use an entity, obviously extremely important that you follow the kind of the formalities, right? So that you don't commingle your assets, that you're not paying your electric bill or your house payment out of your business account, that you keep separate books and records, maybe even that you have kind of make sure that your entity's in good standing. That's a big one, right? I mean, how often do we see clients that their entities are not even in good standing with the Secretary of State? And that could be a reason that someone could pierce the corporate veil, as you mentioned. But just doing those little things, I think, are big to make sure that you have as many odds stacked in your favor as you can.
Yeah, and bottom line is, whatever a creditor can pierce or get through, so can the IRS.
Right.
So
Right.
it's the same laws that apply to both of them. So anyway, it's just very, very important. And now there's some limitations. For example, having a professional entity in a state where you're required to have that entity set up in that state. That's an exception generally, to where you're not going to be able to go pick and choose, what state you're going to set up your professional corporation or professional limited liability company in. But again, we're not as concerned about the operating entities that for the most part are just going to have a checking account in them. We're more concerned about those LLCs or those entities that are going to contain your wealth and other assets that you're trying to protect. So if you go back to that trifecta, these are the entities that will be owning assets on the right of that red bar. The entity, your operating entity for that has the bullseye on its chest, that for the most part is not going to be the entity that you're going to be accumulating assets and investments in.
Right.
So
right.
Todd, let's talk a little bit about asset protection trust. This is kind of near and dear to my heart, because I really started researching these about 25 years ago, and that's when I came across Rob Lambert's website and got to know Rob pretty well in the process. But give us a little bit of an overview of the different types of asset protection trusts that are out there.
Okay, yeah. So the asset protection trust, I mean, the kind of the two types are the domestic asset protection trust, which is really an irrevocable trust with independent trustees. And there's kind of several trusts or several states that have maybe more favorable laws as it relates to domestic asset protection trust. We mentioned a few of them on there. Nevada, Wyoming, South Dakota are maybe some of the preferred states. These statutes too, are relatively new. So that's maybe one knock against the domestic asset protection trust, is that there's not a lot of case law in some of these states. But I still think it's a good tool. I think it's much better than not having a domestic asset protection planning trust or a domestic asset protection trust in place. I think that it is a good tool to utilize. And then the other type of trust that you could use would be an offshore asset protection trust. And once again, an irrevocable trust with an independent trustee, but it would be domiciled in a foreign country. And those foreign countries wouldn't recognize a U.S. judgment. So if you did get a judgment against you in the U.S., then your creditor would be forced to refile that lawsuit in the jurisdiction where you had your offshore asset protection trust. Dave, anything you want to add to that?
No, but I think tell us what you think is the best country, because I think there's about 21 or so separate countries out there that don't recognize foreign judgments. There's one that kind of rises to the top, and I think a lot of people's opinion.
Yeah, I mean, I think the jurisdiction that we think is the best is Belize. And and we've kind of put some of the benefits of Belize down there so that you could see, but obviously, I mean, they're pretty huge. I mean, a plaintiff is required to deposit to make a deposit to even file the suit, and that deposit has to be the greater of $50,000 or 50% of the alleged damages. So once again, the deposit has to be the greater of $50,000 or 50% of the alleged damages. And that in and of itself gets many plaintiffs to say, okay, forget it. We're not going there. There's no belief.
And I think part of that is because most of these lawsuits have been brought by a lawyer working on a contingency and they haven't gotten paid yet. So the
Right.
chances are between slim and none that plaintiff's going to have that much money to cash or cough up. If it's a $10 million judgment that they had against them in the U.S., they're going to have to pony up, $5 million just for the filing fees to file that lawsuit in Belize. Whereas in the U.S., it costs a couple $100 to file a lawsuit. So
Right.
big difference.
Yeah, no, that's a good point, and even another point is too, even if a lawsuit is filed in Belize, the trustee of a Belize offshore asset protection trust has the ability to move the assets to another jurisdiction. So even in that case, the trustee could move them to somewhere, for example, maybe Isle of Man, or the Cook Islands. So there's the ability, or maybe perhaps Nevis, and then the plaintiff would have to start all over again, right, David? Is that?
Yeah, each and every time. So if the rest clause that the trustee is following allows them just to skip, I mean, you're basically playing cat and mouse. So a plaintiff may never catch up, to which country you move the asset. So the asset for the most part is going to be an LLC, domiciled in that country that's then owned by the trust. So all the trustee has to do is really just move the LLC to another jurisdiction, which, rather than all of the underlying properties that may be in that LLC.
Right. Which that makes it a lot easier, right? I mean, if you have multiple assets inside the LLC, or perhaps it's even some type of series LLC, it's a lot easier just to move the LLC versus moving all the multiple assets.
That's correct.
But yeah, we kind of wanted to just maybe give you guys too a example of what a asset protection plan might look like. And so on this slide, we kind of show a domestic asset protection trust structure. And you can see at the top that, we talked about the wrappers for each of your assets. And so we have a domestic LLC. You can see, we'd want to use an LLC in one of those jurisdictions that has the charging order protection. And we've kind of shown it here where you have each of your assets in a separate LLC. And then those LLCs might be owned in this scenario by a family limited partnership. And then we have a 1% general partner, and we use a domestic management LLC to own that 1% general partnership interest. And that 1% controls the entire family limited partnership. And then we have the 99% limited partnership interest that's owned by the domestic asset protection trust. And then the domestic management LLC that owns the 1% general partner interest is owned by your revocable living trust, and everything could flow down to a GST dynasty trust that would be not subject to estate tax. This is a pretty good plan. I mean, Dave, do you have anything to comment on this domestic asset protection trust structure?
Well, this may be more of an estate tax question or a question, but what does the GST stand for and why is it important?
So the GST is a generation skipping transfer tax. And the IRS got smart because really, really rich people figured out, hey, we have enough money. So, what we'll do is we'll give, and our kids have enough money. So we'll just skip our kids and give everything to our grandchildren. So when the IRS figured that out, they implemented what's called a generation skipping transfer tax. And so now they only allow you to skip your children with a certain amount of assets. But having a dynasty trust would allow us to at least skip, our children, or a client could skip their children with at least the amount of their GST skipping, exemption amount.
And that could all be put into the original revocable living trust, and then just as each generation passes away, including the children, then you'd get the exemption on the, when the client died, but that trust would then escape taxation at every generation, thereafter. So
right.
It's never, as long as that money stays in trust, it never will be taxed on any generations for estate tax purposes.
Right. So you almost create like your own family bank, and you don't have it eroded by estate tax or generation skipping transfer tax.
Yeah, exactly. Well, now my favorite topic, which is an offshore asset protection trust. Tell us a little bit about how that would look different.
Yeah, so we still have the domestic LLCs, and the assets are owned inside of those domestic LLCs. But the difference being that we mentioned Belize being our favorite jurisdiction, so we would have a Belize limited liability company that would own each of the domestic LLCs, and then that Belize limited liability company would be owned by Belize Asset Protection Trust. Um, you can serve as the trust protector. You can also be the manager of the Belize limited liability company. So that's what I like about the structure too, is you don't have to give up all control. You can still maintain a lot of control in this structure. And then once again, you can see that we have the descendants generation skipping transfer tax dynasty trust that everything's flowing into.
Yeah, excellent. Yeah, and sometimes people ask, well, how is all this going to be taxed on my tax return? Well, these can be designed so the Belize LLC can be set up as since it's a single member, as what is described as a disregarded entity. So meaning that it doesn't have to file a federal income tax return every year. The Belize Asset Protection Trust similarly can be taxed as what's called a grantor trust under tax law, meaning that it does not have to file a separate tax return. So if you look at someone who has a Belize LLC that's a disregarded entity owned by a Belize Asset Protection Trust, and you look at their individual income tax return, you would not be able to tell by looking at their tax return that those entities exist, because they're virtually invisible from an income tax standpoint, but they're 100% applicable for the purposes of asset protection planning.
Well, that's really nice too, right? So you don't have all these added tax returns. I mean, that you're maybe not for you, Dave. I mean, I'm sure your company would like to do the tax returns, but I mean, for the client, I think it's a really, really great strategy.
Yeah, I agree. Well, thank you, Todd. That was very informational. So I'd like to pivot just in the time we have left to talk about one of my, second favorite topics besides asset protection planning, which is using private insurance as an additional tax strategy to also reduce and mitigate risk. So, Craig, I'm going to let you describe a little bit about private insurance.
David, thank you so much. We have been, again, I mentioned my servicing company's been doing this 30 years. For 20 years, we've been using a Native American tribe. Of course, they've had sovereignty back to 1934 and President Roosevelt. So basically, a private insurance company is one that we would stand up for you if you're a single member physician, or you're in 12 orthopedics working together. We would stand up an insurance company, and that has many benefits. One is, for every dollar that you remit in premium to that ends up in your bank. I mean, Todd, you mentioned becoming your own bank. That's another reason to do this. Premium is treated favorably in the tax world because you might have a claim one day. So instead of sending money to State Farm, in Oklahoma, you would send it to Boomer Sooner Re or Pistol Pete Re. That money sits in your insurance company, and you can use that to expand your enterprise, et cetera. They're very popular. Established to provide risk management. Yes, they are insurance companies, and we have an actuary come in and look at your risk. So if you're a business leader, or you're an orthopedic, or you're a podiatrist, whatever you are, you're going to have risk around your enterprise, and those, we're going to identify and cover those risk profiles. So they're super popular. They've doubled since 2013. Today, there's $200 billion in reinsurance. That's just in the US. That triples globally. So next slide, David. Thank you. So self-insurance actually goes back to the 1600s, believe it or not. But you might remember in the 1800s, of the world of Henry Ford and Dale Carnegie, the textile business was huge in New England. I mean, the original 13 colonies. Well, there was not enough coverage to cover them when a fire would arise. So they basically started self-insuring in the 1800s. And then there's the 1900s, and then 1955. I won't go through all this, but very importantly, in 1986, Ronald Reagan who was probably the last great president for small and mid-sized businesses across the U.S. By the way, the U.S. calls a mid-sized business 500 million and below. He formalized this with Congress. So in 1986, Ronald Reagan basically set up reinsurance formally in the tax code under the Tax Reform Act in his second term. Okay, next slide. Today, I think I mentioned this. Today, there's $200 billion in self-insurance. And by the way, globally, it's been up 12% over last year. So you can see this trend. Warren Buffett, by the way, owns Geico. Right, Berkshire Hathaway owns Geico. His $52 billion, Warren Buffett, is in insurance and reinsurance. So when he's deploying those dollars and buying up blocks of stock in Apple and Google and Amazon, he's buying that with tax advantage premium. That's the same thing you can do when you turn on this tool. You can expand your business or buy those Airbnbs or buy that second home in Vail, Colorado through what? Your tax advantage premium sitting there in your insurance company. So they're super popular. They're fantastic tools.
And just as a side note, I don't think Warren likes Apple stock anymore.
Probably not.
As of last week.
Right. 92% of Fortune 500s use some form of reinsurance. 92% of Fortune 500s. About that same percent of automobile dealers. So Todd, you go down in Bixby, Oklahoma and buy a King Ranch F-150 truck. That dealer is self-insuring that risk. That's why they're always pushing these extended warranties. If there was not a claim, if nothing happened, the transmission doesn't go out in 2 years, guess what? He just made $2,000 of tax-free dollars. He's self-insuring that risk. So automobile dealers have been power users of this since the 50s. And again, this was legitimized by Ronald Reagan in the tax code in 1986. So this goes back, 4 decades in the tax code here with the IRS. What do we insure? Well, look at this industries. Cannabis is real hot right now. Home builders is a real hot topic. The largest home builder in Oklahoma City, building $1 million homes, has this, and he loves it. He tells all his friends, you got to self-insure, your risk relative to being a home builder. Aerospace, aviation, energy. I talked to a company today out of Midland, Odessa, in energy doing $200 million. And they want me to come to their headquarters in Houston and turn on this tool for them. So restaurants, hospitality, franchising. In the medical field, it's very popular for not a W-2 that works at ER. This is not a good tool for someone that makes a lot of money as a W-2 at St. Anthony's Hospital. But if you are an entrepreneurial or an independent physician, or you're in a group with 11 of your other ortho friends, this is a fascinating tool to turn on. Because you have what? Risk. If you guys own a clinic, you have trespassing risk and slip and fall risk and property risk and brand risk and reputational risk and cyber risk. You have all these risks on top of your medical malpractice, and we can self-insure that. So we just love this tool. So here's a good thank you for doing that. This is a graphical representation of what I'm talking about. You're going to keep your primary P&C, your property and casualty. So if you're using Chubb's or Federated or State Farm, whoever you're using, it doesn't matter. That's going to cover your auto, your GL, probably your medical malpractice if you're a physician, and your workers' comp. But when we turn on our insurance company that you own, that's going to cover your underinsured risk, which you basically have anyway operationally. You already have this risk. We're just going to have an actuary identify them and turn that into a policy. So you don't have to call State Farm. You can call, in my Oklahoma example, Boomer Sooner, and you can satisfy that $10,000 loss with your own pre-tax money. You don't have to call and have your premiums go up with your P&C friend. So these are some underinsured risks that are very typical in this world. Loss of key employee, loss of key supplier, loss of key contract, loss of key vendor, embezzlement, regulatory risk, legal risk, litigation risk, D&O, E&O. Think about the pandemic, business interruption. So if the next version of COVID comes along and a dentist loses $100,000 because no one's coming to get, dental work, he can satisfy that loss out of his insurance company with that tax advantage premium. He can bring that back over to his P&L. They're just wildly powerful and wildly flexible.
And wildly popular. I think, and I think that's what is so exciting about it is, especially with the recent development that, that we've partnered to create, which is bringing private insurance down, to a level where a lot of our physician clients who otherwise wouldn't meet the revenue requirements, which are set pretty high, generally in the $1.5 to $4 million range. We now have a solution for that by allowing our clients that have as much as $500,000 of business income that they can now start enjoying the benefit of it based on the new developments that you and I have been working on.
David, thank you. Our top customer right now is 850 million. I mentioned one this morning at 200 million. If you are a business leader / physician and you're earning 500,000 top line revenue, we have a way now for you to participate. So I would highly advise you to jump on this call August 21 at 4 p.m. Central Time.
Great. So thank you, Craig. So yeah, we'll be sending out invites for this. Share it with your friends or colleagues. I think it's going to be very valuable for those who can't attend live. Just go ahead and register, and we'll send you the link to the recording afterwards. So, well, thank you, Todd and Craig, for those great presentations on asset protection and private insurance. Those are two of my hot button items that I like to talk about. So, well, let's transition into next steps. We're running out a little bit of time, but just want to wrap up and then open it up for questions and answers. So we've got Angie on the call. Angie, do you want to walk through what our model here at Providence CPAs is and what our process looks like?
Yes, I'd love to. Thank you, David. It's been great so far. I do want to jump into what our strategic wealth system model looks like. If we are partnering with a client, these are all of the steps where we want to have you strong in all of these areas, starting off with the tax minimization process. So this is where we are going to work with you to set up a written plan, or what we call the strategic tax blueprint, moving into reducing your taxes, and then getting you to a level where you feel like you have control of your money. And then the very last step here, and you're going to see this is the most exciting part, is getting our client to where you feel like you have financial independence via tax planning. So getting you equally strong in all of these areas. Our goal is to get you to financial independence sooner rather than later. And so what does our process look like when we are moving forward with a client? We start off with that strategic tax blueprint, which I just mentioned. And then if you love everything you see after we meet with you and go over your presentation, we'll immediately go into onboarding and implementation. And then lastly, we will do year-end tax planning with you. And that's where everything gets really exciting, where we can really see what tax minimization we're showing you. If we are moving forward with a client, we do dive into these processes a little deeper. But on this call today, we just want to give you a light overview. So as far as next steps, many of you are already existing clients, but if you're new here and want to find out more about our services, I would love to meet with you to have an introductory call. We can go ahead and put my email address here on the messaging. So if you want to contact me via email, I'd love to follow up with you and schedule a call. We can discuss further tax planning and implementation. You can also scan that cool QR code and schedule with me that way.
And Angie, do you want to type in the chat box what your email address is, and everyone will have access to that, or use the QR code? That'll simplify it a little bit. Okay, and then let's just move to just to wrap things up. Whoops, my computer is locking up. Hang on a second. There we go.
I did want to share the book. Yeah. So for those of you that have not read The Richest Doctor, it's really informative and insightful. If you scan the QR code, you can get those first 2 chapters to read, and then go from there if you like it. So we do have questions. Yes. Absolutely. Okay, so questions of the first one we have here. All right. If a former patient sues me for malpractice, and I am being sued at the same time by my former partner, who comes first in the lawsuit, the patient or the partner? Good one.
Well, I don't know if we have the ability to answer that question. That's really going to come up to, if you've got two simultaneous lawsuits going on, it's going to be a battle for the assets. So I think that's where, hopefully having a good defense counsel, representing you on both cases. But at the end of the day, you're going to have to fight both cases as if either one of them can win, and then just hope that you can eliminate or settle them favorably.
To piggyback off that, they've also said, what assets do I need to protect in this kind of lawsuit? We don't own our office space and have minimal assets outside of cash.
Well, one asset, so for those who don't really have a lot of material wealth that we're trying to protect, I would say that for the younger business owner or physician, you also an asset that a lot of times you don't think about that can be taken in the form of a judgment is your income. So income becomes a very significant asset when you look at it over a career, and so that's just although other material assets or financial assets may not be significant, your future income could be very valuable from the standpoint of a creditor or a judgment.
All right, and then we have another one. So if I am a doctor and I currently have 2 clinics with goals of several more, does it make sense to do a MSO company that pays the admin team and holds all of the assets? Then clinics only have smaller portions of money.
So I'll take a
Okay.
first attempt, and then Todd, you can maybe give your opinion. But I would say that from a financial management standpoint, it with the goal of having multiple clinics, it probably does make sense to consolidate the operations financially under one entity, just so you only have one accounting system you have to maintain, one payroll system, and then just keep track each of those profit and loss statements, all under one financial statement, but for each individual clinic. Todd, do you want to address the question as far as maybe how ownership of the actual clinics would be owned?
I think you're kind of on the right track as far as potentially having each of the clinics owned by a separate entity. Just like we discussed today on the webinar, putting each of those assets in a different wrapper. And I don't know if you own the real estate related to the clinics or not, but I always think it's a good idea to separate the different assets like in that manner. It also might have some advantages if someone wants to buy the clinics. Perhaps you want to sell 1 or 2 clinics, but don't want to sell all of them. And like David mentioned, just keeping separate P&Ls by each clinic is a good idea as well. But probably makes a lot of sense to have just that management entity that you run, everything through as far as payroll and some of the other common expenses.
And Angie, I would add that is a picture perfect scenario for self-insurance. So if there's 5 doctors that all own those clinics and they have, a pro rata ownership, we can mirror that owner representation in an insurance company, and they can self-insure, again, the property, the practice, the reputation, all those things. When they sell those companies, when they're tired and they want to go fish and travel and golf, they're left with that pot of gold stacked up in their insurance company. That doesn't have to be sold with their business sell-off.
Thank you. We have another one. How does private insurance complement other asset protection strategies, such as LLCs and trusts, to provide comprehensive coverage?
Great question. So we're not turning off your commercial P&C. This augments it. That, in fact, by law, we don't duplicate anything covered by State Farm or Gallagher or Chubb or anybody you have. So what you're doing is you're augmenting your risk. But said another way, Angie, you already have those risks operationally. So what you're doing is you're standing up an insurance company and you're remitting premium in case there is a claim a claim, you can move those tax advantage premiums from your insurance company back over to your P&L, and you're satisfying that loss. Now you're doing that with your own tax advantage premium. But think about it this way: if there's only a 30% claim ratio, you can invest that 70% and put that money to work. So it's a win-win scenario.
Great. All right, we have another one. So what are the most common mistakes business owners, professionals make when it comes to asset protection, and how can that be avoided?
Well, I think that's a law school exam question that you could write for a couple of days on. So, you can basically go through the digest of, lawsuits against business owners and see, all of the unique fact situations that have resulted in, business owners not only getting sued, but then, having judgments against them and losing either their business or a lot of money. So, I think I don't know if there's a specific list of do's and don'ts other than just, make sure you surround yourself with good advisors who can, educate you or counsel you on best practices. Have independent advisors that can review, insurance policies for you, or make sure you have somebody objectively looking over your shoulder from a tax standpoint to make sure you're not, you've got everything set up, properly with your business, and then your estate planning, documents are all in order. So, I mean, for the most part, all we can do is just try to gain wisdom by reading and understanding, stories that where people had gotten into trouble in the past, and just making, sure that you don't repeat those, those actions, and then just doing your best to, to operate your business and live life within the boundaries. And if you feel like you're pushing those boundaries, just, take a stop and pause and try to surround yourself with information or wise counsel that can, guide you through the right decisions. I hate to sound like Solomon in the book of Proverbs, but the book of Proverbs would be a good book to read too on risk mitigation.
Right. I think that wraps up our last question. And we did put my email address in the chat if anyone wants to reach out to me to schedule.
All right. Well, thank you everyone again, for those of you who hung on and or watched this to the end. Again, we're really excited about the topics that we talked about. Really appreciative of the legal expertise that Todd brings to the table, and the insurance and risk mitigation expertise that Craig brings. And we hope that everyone can join us here in a couple of weeks when we talk more specifically about how private insurance can be utilized, and most importantly, how it can help you build wealth. So anyway, again, thank you everyone for attending, and we'll hope to talk to you soon.
Thank you.
Bye. Thank you guys.